This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and this week's guest is Drew Dolan, Principal and Fund Manager with DXD Capital. Over his 20-year career in real estate, Drew has become an expert on deal structure, debt, capital procurement, and management. He has raised over $500 million and placed over $1 billion in debt on his various real estate investments. As a fund manager and principal at DXD, he created the fund structure and oversaw the capital raise for DXD Self-Storage Fund 1, which launched in 2020, raising $53 million and then placed over $50 million in debt in the very first year. He previously served as fund manager for the Titan Development Real Estate Fund, a $112 million fund focused on ground-up development. Drew has been quoted in the Wall Street Journal and New York Times as an expert in the self-storage industry, and he's currently a member of YPO and holds a bachelor's degree in industrial engineering from Arizona State University. So without further ado, please enjoy my conversation with Drew Dolan of DXD Capital. Hey, Drew, welcome to the show.
Hey, Scott. Thanks for having me.
Well, I'm so glad that we were able to connect. We've talked with several folks within your fund and your organization on multiple topics because you guys are doing a lot in the business, but glad that you and I have a chance to sit down and chat. Turn on the microphone and the camera so that Storage Nation can learn a little bit more about what your role is at the DXD Fund. So I've given everybody a little bit of background on you, your bio, some history. If you would, why don't you fill in the gaps and then let's take a deep dive into what you're doing right now and how you're approaching this market that is ever-changing.
Cool. Yeah, I've been in real estate for 17 years. I was in construction before that. And my background up until about 3 years ago was incredibly diverse with one commonality. It was always ground up. Like that is what, I did from day one. It was my bread and butter. So I know that process. Acquisitions, which is a common strategy, was just not something we did. But what was unique about it is we did lots of different, office, retail, multifamily, senior living, and those are all very, very unique asset classes. And I'll give you senior living as an example. It's really an operating business that uses real estate to make its money versus self-storage, which is real estate that has an operating business to capitalize on the real estate. And so I jumped into storage about 6 years ago, really because we've been asked so many times, why aren't you doing self-storage? You do all these other things that are more complicated. Why not self-storage? And we found an opportunity. I live in New Mexico, and we found a handful of opportunities right here that nobody was really paying attention to, because it is a tertiary market. So we did a total of 6 self-storage deals in the first fund I ran, pre-DXD. And that fund had senior living, multifamily, industrial, and storage. And storage did the best of all the assets. No surprise. And, I really just kind of fell in love with the asset because I love the growth trajectory in general of just how many more people are using it. And of course, COVID has been just like jet fuel to that. But I also love the business. And, prior to storage, most of my expertise was spent on senior living. And, just how complicated that business is and how much it got crushed through COVID with, the cost of PPE and the cost of labor and just how difficult, I would say, of all the asset classes, that one certainly has to be up there, if not the top of what really suffered during COVID. And on the flip side, you have multifamily and storage, industrial that did extremely well. And so we kicked off DXD about 2.5 years ago with this idea that we can use data and tech tools at a very high scale to make investment decisions with this goal that, we really want to be the best investor in the space. And, most of our focus today is ground up just because that's where we're seeing, us, DXD, seeing the most opportunities.
Well, I have had the pleasure, and Storage Nation has had the honor of listening to James and Corey talk about the data and how your company has begun, first of all, for investing purposes. Yeah, like any good entrepreneur or entrepreneurial organization, if you don't find something in the marketplace, a tool or resource that you need for your business, then you just go out and create it. And hats off to you guys, and the rest of us get to benefit from you digging in and then sharing it by way of exchange for dollars. But the tools and the resources you put out by way of data has really allowed folks to continue to, has allowed folks to begin to just invest much smarter, obviously, and much faster. We were, in my conversation with Corey, we chatted about when I got in the business in store. Well, I got been investing in real estate since 93, but in storage for 17 years in '05. And we waited for that book to come out from that organization that talked about the demand study and square foot per capita in certain markets. And we'd wait for that to come out once a year and find out what are the best markets that have the lowest square foot per capita, only to find out that it's not only is it outdated, but it doesn't really speak to the demand and doesn't speak to the rental rates, and it's outdated the minute that it hits your doorstep. And so to be able to have the tools available now to do more, not only looking at the demand factors, looking at rental rates, putting it all together, but doing dynamic underwriting. We have dynamic pricing in our stores. When we rent a 10 by 10, the next guy in line or gal in line, it goes up by $3 or $4, and we never took that approach with underwriting. We just set these benchmarks for the year and ran it across. And if the bank said great, then we would move on and hope that that business model would work out. But taking that data approach is what separates the best from the rest, and it is even more important now. So if you would, let's speak a little bit to the genesis of the data side. You first of all, you're using it in the investing side of the business, and then at what point did you decide that, hey, I think we just need to package this up and share it in exchange for some dollars, and tell us how that all came about.
Yeah, and just for clarification, Radius was created by James and Corey, and they have a third partner. And I'm not involved in Radius. What I am involved with is partnering with those guys on the DXD, the capitalizing front. And so I think it's really fascinating that, Radius is 5 or 6 years old. And up until then, the industry didn't have data. And so, from a sophistication standpoint, it's decades behind other asset classes, and to me, that was also one of the opportunities I saw. And there are people, groups, companies that have done so well in storage, and they're doing their analysis the same way they did 40 years ago. It's like dinosaurs ruling the earth. And why would they change when they've done so well? Because the product type has just in general done so well, because the growth dynamics are there. And so, what I think we do at DXD is use data, bring tools, and start to try to predict where we're going with storage. And so what Radius gives you is this ability to, at that exact moment, look backwards on performance. That day, that month, that years, you can see how the performance is of that asset class and of that submarket. So what everybody's doing is looking backwards and saying, here's what's going to happen looking forward. And I think I know what we're doing differently is really taking the next step on looking forward and being able to say, okay, yes, we can't predict what's happening, but we know these factors are going to increase storage, and they're generic. They're not unique. It's just how all that data comes together to make decisions. And it's job growth, population growth, incomes, percentage of renters. We very, very rarely look at, a per square foot metric because it's all so different across the country. And there's very few conclusions you can draw because of the differentiators across the country. And so, from a data perspective, I feel like I know we're on the forefront of it with just this opportunity to predict where we should go. And I probably should say, there's so much money has poured into self-storage in the last 2 years, through COVID. Mainly because, it's done really well, but also that money was going into student housing or senior living, and it left those sectors and went in more industrial, more storage. Well, what happened when all that money poured in, those equity players, whether they're private equity or institution, they want to put that money to work right away. They don't have the patience to wait for development. So they go bid on stabilized, core plus, value add deals. And when you have so much more competition, it drives prices up and it drives returns down. So it's been hard for us to find great value add deals, that are brokered. You can still find off market. You got to work really hard. But, in our opinion, we're just not the lowest cost of capital. So when we got to compete with another group that has very inexpensive capital, we're not going to win that deal, which is really why we're almost primarily focused on ground up at the moment. That will shift. Our second fund is both ground up and value add. But, I think in storage, you got to be nimble enough to go and figure out what the opportunity is and really pivot to take advantage of that opportunity.
Well, at the end of the day, this, I don't know about you, but it's the hunt. It is the competition. If you find a good site to be able to build on and you secure it and then you begin to build, for me, there's a lot of joy in that because I feel like I beat my competition. I found a spot before somebody else did. And same thing with an acquisition. You find a turnaround and maybe somebody else looked at it, but you found a way to be able to create value in it that somebody else didn't, or else they just couldn't get it across the finish line. And so it is that hunt that is exciting. And, our last fund was all acquisitions. It was a value add. And we're going to be following the same model that you just mentioned now. Heading into COVID, we know there's going to be some folks that are struggling in their development projects or conversions. Their cost of capital has changed. Many things have changed. And so some of these projects may have to be sold or they may go back to the banks. And we saw this happen the last time around, and that's why we've been preparing for this time frame. And so to be opportunistic, as you mentioned, to be able to take them down, if you got the skill set to do them both, then why not have a vehicle to be able to do it? So I want to circle back, Drew. You're a ground up guy. At least that's been the focus recently and in the past 2 years. People that never set out to be merchant developers all of a sudden became merchant developers because somebody was waiting for them with a big check at certificate of occupancy. And then sometimes that check was so big that we couldn't put that project in our fund or hold on to it. Did you hold tight to the business model because you've got a big fund, you've got to put assets in, you've raised capital or you're raising capital? Did you pivot towards that side of the model where you began selling off or selling earlier than you had anticipated? Or were you still more long-term in your funds, which you mentioned, I believe, are a 7 and 10 year in focus for the most part?
Yeah, the very first fund I ran outside DXD, IRR driven, as the GP, we were incentivized to sell immediately. Not to wait around. It was pure IRR. I mean, of course, we looked at multiplier because who cares if it's a 100 IRR, but 1.1 multiplier. But we wanted to sell very quickly. In DXD, the fund one and fund two, I kind of restructured things because I had a friend tell me once, selling real estate is like peeing in your pants. Feels good for about 20 seconds, and then you regret it from then on out. And I thought that was a pretty good analogy,
Right,
and the portfolio premium, the scale is so much more important in self-storage than it is in other asset classes. And so what we want to do is build them. We want to refi, pull some cash off the table, hold them, let those assets mature. We think we picked good locations that the rent growth is going to outpace the national average. And then at the end of the day, do we consolidate all those into an evergreen portfolio, or do we sell them as a package? If we can get to a certain number of assets, our exits, whether it's IPO or sell the whole thing to an institution or REIT, I mean, they're really, really endless. And so that's the scale of self-storage that excites us. Mm-hmm. But if I didn't ever have to sell another asset, just recapitalize through different partnerships, I'd be really happy.
Yeah, you and me both. I mean, that is certainly not a game, but that are the rules that we have to play by. And that is we put our projections out there to produce an IRR. And, once that project is stabilized and your concessions burn off, then it's a challenge to continue to do that year in, year out and keep those the IRR up where the investors pleased. And so that is, those are the decision points. But, we are excited about the opportunities that we have coming up. And like you, certainly We took advantage of the fact that, when you scale a portfolio and sell it, you get a half to 1 basis points higher in terms of valuation, or a lower cap rate. And that equates to real dollars when you're rolling up some, assets that have lots of commas and zeros behind them. And that's always been our goal, but we just found ourselves doing it a little bit quicker than before. And this is the wild, wild west still. It's the last great frontier in commercial real estate. The other asset classes, they're pretty mature. The REIT and the national folks, they own 80 to 90% of the industry in retail, in hospitality, in multifamily, whereas self-storage is the opposite. We're catching up, but we're still 80% are still owned by individual investors and not the REITs and not the national folks. And so we have the opportunity to go out and buy and develop and pool these together and roll them up. And so that's another reason why there's a whole lot of interest in our asset class, beside the fact that it performs well during a recession and inflationary periods. And so that has been the model all along. But always interesting to talk to folks like yourself that are you tempted to take the money because you are IRR driven, or are you in for the long haul? So how does that play into your approach to the market right now? Are your projections based upon an exit at a cap rate within 5 to 7 years? Are you matching it with the fund? And how are you setting that exit and that all-important price, which is usually tied to a cap rate? You've got all the data at your disposal because you own it all and you're producing it all out there. But how are you projecting when and what those exit prices are going to be in your portfolios you're looking forward to the next 3, 5, 7 years?
That's a great question. And I'd say that's the hardest, what that cap rate is. That's the hardest to predict. I think if you're leaning toward the conservative side, if you protect your downside, the upside is always going to take care of itself. But typically what we're doing is we're inflating everything to make sure that deal is stressed. If we're getting 5% interest, we got 8 plugged in there because we want to have enough interest reserve. We have 30 months of lease up, and, we're realistic about what discounts we need and what our rents are to market, because with ground up, it's the ultimate spec project, versus a value add. You have some data of what the market's going to tell you. And so developers, by their nature, we're all optimists, and we can easily convince ourselves that we're going to get above market and there'll be no discounts. And this project's so special, it's going to get below a 5 cap. And so you get into this cycle of kind of falling in love with your deals or making deals work when they probably shouldn't work. And I think being honest with yourself, having other people look at the deals is really, really valuable, because self-storage, there's a lot of people that got hurt 16, 17, 18 when overbuilding occurred, because, I heard a story about a friend that developed in Houston, and Public Storage went 2 miles south and 2 miles north of him. And they just crushed him, in terms of what they discounted. And ultimately he got his equity back, but, made no profit, and his investors made no profit. So, circling back to your question, we look at everything in a 4-year time horizon and a 7-year. The 4-year is roughly 12 months to build, 30 months to lease up, another 6 months to get the rents to economic market. The 7-year is the same thing, but we're going to refi at year 4, and then we're going to hold it 3 more years to wait till those rents mature. Of course, the IRR in the 7 year is going to be lower than the 4-year, but we want our investors to know, look, it could be 7 years. Are you comfortable with that IRR? Are you comfortable with what the refi looks like? And, what we do is make best guesses. We really guess. And I think ultimately the one job of a real estate developer is to control risk. We can't control, there's uncontrollable risks that we can't solve for, but there is controllable risk. And to put projections and underwriting in place that, we can withstand a lot of bad things happen, to this deal or the economy.
Agree 100%. Echo that as well. And I found ourselves, because the market is changing so much, that we're going back and looking at those numbers where before it may be not necessarily a set it and forget it if we had a 4-year or 7-year strategy that we're just, we're looking at the numbers to make sure we're on track in year 3 or, and at the end of the year. But now, again, once looking at the timing of this, always with an eye towards the IRR and an equity multiple, but does it make sense to sell now 2 or 3 years ahead of time and really with the downside risk in mind? There are some of these projects that we sold out of where both the equity multiple and the IR was stronger. And so could we have ridden it a little bit longer? Yeah. We're 2 years early on this, but then interest rates going up. We don't know what's going to happen in the market. Then we're doing nothing but mitigating downside risk at that point. And so immediately put a couple of these assets up for sale that it just made sense to do so. Our investors were not displeased with us, and several of those we didn't end up in a retrade situation when rates began to go up. So I think part of that was the right call. But the balance, and I'll ask you this as well, within that, without getting too far in the weeds, but within that 4 to 7 year span, then how does that move and what does that look like then, if interest rates are on the way up and you're at the top of the bell curve or on the bottom of the bell curve and when to exit? I mean, it kind of goes back to my cap rate question, but do you then alter your, the 4 and the 7 is no longer 4 and a 7. Now it's maybe a 3 and a 4, just depending upon where we're at and the interest rate cycle. Does that question make sense, Drew?
A little bit. I'll give you some details and you can tell me if you want to take it further, but we add about 250 basis points to our interest rate at that moment. And then we also add 250 basis points to what we could refi it for, at that 4-year.
And that's across the board. So at a snapshot in time, when you're entering a project, you just add 250 off the bat and that's your buffer?
Yep. Well, that's a lot of room for us to go wrong. And then, of course, we stress test it. What happens if it went to 350? Ultimately, I think what is underestimated or underappreciated are the lenders that you got to work with. The GFC, the lenders got a ton of pressure from the Fed to get bad assets. And of course, that was a real estate subprime driven recession. What we had in the last 2 years was not, real estate did not cause the problem. And so you had the Fed not putting any pressure on banks, and every bank wanted to work with you through COVID. That's changed a little bit. There is some pressure, and you got a lot of big banks that are pulling back either, through the end of the year or the next 6 months. And, when the big banks pull back, that means the smaller regional local banks will get more pressure, see more deals, but they only have a certain amount of money to lend. So it is a very difficult time to develop with construction costs, with municipalities that are, very dysfunctional, with interest rates, and on top of all of this is just this debt uncertainty, and making sure you got a relationship with a bank that if something goes wrong, they're going to work with you. They're going to ride it out because, the thing I think about real estate is time cures a lot of issues in real estate.
Sure does.
But you have to have the time, whether it's from your bank or an equity partner. You just need a lot more time than you think, and get that time because that will solve your problems. Generally.
And getting that time, it means you've raised enough capital to lengthen your runway if you need more time as well. And with proper contingencies all across, from interest reserves to construction, all of the above, and not trying to put a square peg in a round hole. The last thing you want to cut off is your contingencies and remove that from the budget. That doesn't do anybody any good. So, Drew, you came out of the gate kind of all guns blazing, with your background and working with some large funds and also with DXD. There's a whole lot of folks on the podcast here that are all across the board at different levels of experience, looking to scale at different speed. Can you speak to that? There's the folks out there that have heard over and over again, keep it small and keep it all. And there's a lot of merit in, growing at a manageable pace. Otherwise, you find yourself with an organization that may be over payrolled and you're making the same amount of money, working twice the amount of hours as you were back when you were smaller and just doing a syndication project or development deal at a time or 2 a year. The pace that you're at right now, you got a sizable team, sizable staff, and obviously that wasn't done overnight. But how did you manage that scale? And was there an intention to get to that level, or did you just find that you had a great business model and you were firing on all cylinders? So let's just add gas to this and go and see where it takes us.
that's what I appreciate the most about the position I'm in now, having had to develop multifamily and senior living and, understand industrial. We just have to understand storage, and we get to repeat the same thing again and again and again and always get better. So I love that fact, and we can build tools and processes. We have 25 people in the company. We'll have broken ground on 8 deals this year, likely 15 next year, 2 the year before in 21. And so that's a lot of projects. But when we get to a certain scale, we can do that with less people because we're just repeating. The whole idea of whether you keep it all or you raise outside money, I think it comes down to risk. How much risk do you really want to take? If you're 100% of it, you're 100% of the risk. And if your financial situation says, I'm going all in, it's either going to be a really good deal or a really bad deal, versus what we've been doing. Our first fund, the equity we raised was 100% of the equity. Our second fund is a GP fund, so we'll put 10% in. But we really want to spread out that risk amongst investors because, even when you have so much buffer on contingencies and interest reserve and unfunded operating liability, you might need a capital call. And you got to be able to go back to those investors and say, hey guys, we missed it. We need another 500,000, but it's worth doing. And here's why. And so if that was just us, or if we were 50% of the equity and we had problems with a lot of deals, we wouldn't be able to be there. And so I personally have never subscribed. I've just never done it where it's just internal or just me, because I think the value is making a bigger pie, doing more, and taking a piece of that pie. And I think when you become an expert, which I think in real estate really takes 5 years, no matter how much you read, CCIM classes, Google, podcast, I think that's all really good. But making mistakes is where the learning occurs in real estate. And, the goal is to never make the same mistake.
Yep.
However, you'll never see the exact same situation again. And so all we're doing is taking all these experiences over 17 years and saying, this looks like that, or this is what burned me last time, or this is the advantage I took. And you're trying to make the most educated decision. And you brought up something earlier on, which was, you might take advantage of an opportunity this way, and I might do it that way. That's really at its heart what I love about real estate. It's the most creative, industry. And we might have different ideas, but those different ideas on how to capitalize might meet different goals. And so you're going to do something completely different than I am. And that's good. And I love that ability to just think outside the box and really create wealth based on that.
Yeah, well, as we have a saying around here, it really boils down to focusing on the damn thing, and that's that deals are made. And it does give you that creative license to go out and take a look at a project one way versus another, and from a fund level versus an individual investor level, what may be a great opportunity for somebody because it's a turnkey facility that's already stabilized and throws off cash, and it's like the equivalent of going into Macy's and just paying retail full price, throw it on the register, and hey, this beats the stock market, I'll do that. Versus there's a hair on this, and you know what, no bank's going to fund it, and I'm willing to put all my cash into it, even though I'm going to pay more for it because here's my upside. That's the fun part. It is finding the deals or creating the deal inside of what's out there, and then again for me the thrill of thinking, at least hopefully if it's successful, beating my competition to the punch because they didn't see it or I got there first, one of the two, and that's what gets me excited every day.
I think develop as being optimists. We like the chase. We like the risk. We find winning very, very rewarding. And whether that's winning in a financial sense or notoriety or beating your competition, there's so many different ways to motivate yourself on winning. Our winning to us is being the best investor. If we can give our equity partners the best return, we're going to win. And so we just stay highly, highly focused on doing the right thing for those investors and always putting them first. And we know when they're first and they win, again, we're going to win as well.
Yep. And I believe that's the opportunity that we have in the marketplace right now, which is a couple things that you mentioned, Drew, is that it's risky. It's not for the faint of heart. And for the folks that don't want to take a risk but recognize the upside to that, I'm thankful that we're getting to a place in the marketplace right now where people are pivoting and we can kind of get back to working in the fashion that we used to before a whole bunch of folks came in that were bidding things up and making life a little bit more difficult and making the banks think that things were a little unrealistic in terms of, the interest level in storage out there as well. And if we continue to do, what we've done for so many years and do it better than anybody else, or at least striving to do so in our investors' eyes and building up that confidence in us, that is the ultimate goal. So you've done an incredible job of building and growing a team, Drew, and that is that falls on you as one of the leaders. What would you say as we wrap up our time here? Is there a secret sauce, or what is at the heart of growing a high capacity team that is firing on all cylinders to allow you to do the amount of activity that you're doing?
Yeah, a couple thoughts on that. I mean, the two things that I pay attention to when bringing somebody on board is ambition and enthusiasm. Do they have the ambition to be the best? And do they have the enthusiasm to always get better? Those are what I'm really focused on. I think it is all about the culture. You could have the smartest person who disrupts everything, and that's going to be very bad for an organization. And I've seen it happen firsthand, and it's not fun. But one other very interesting point is we got 3 offices with 25 people, and about half the people are in the office, half the people are spread out. Kind of the cool thing about work from home and the pandemic is you don't have to be together, especially in this business. We want our development guy in Miami to be in Miami or, in the field. And so that's been a huge advantage, allowing us to hire wherever. And one stat that I think is fascinating is 75% of the people that work for DXD had a relationship previous to somebody who worked at DXD. So they came with this box filled in that they're the right cultural fit. I want to work with them.
That's good.
There's no way to figure that out through an interview or a questionnaire. You just got to do it. And I think if we can get through that box, there's a lot we can teach people as long as they're a cultural fit and they have the ambition and the enthusiasm of what we're going for.
Also agree 100%. We thought early on that if on their resume they are a rock star because they've got experience and we don't have to train them in these areas, then we put ourselves in a better position and that we don't have to micromanage them. They already get it, only to find out that it is 100% the wrong way of doing things and that they have to share our core values. And we have to be militant in making sure, to the point where we're doing predictive index and other personality tests to make sure they're a cultural fit, and then explaining to them in the third or fourth interview, here's our culture. Is there anything about this that bothers you or you think that you can't operate under? Because if not, we'll find
feedback.
Well, that's the key. We don't know. I would like to think I'm a good judge of character. My wife is much better, and she also tells me that I'm not the best judge of character because we leave that to her and other high-profile women in our organization to be able to discern that, and they seem to be able to flush that out. But at the end of the day, we still have a 90-day probationary period where, now we're dated or we're engaged at the very least after 90 days, or perhaps even married. And now we'll understand, exactly, do they leave their wet towel on the floor? And, is this a fit? Is this going to disrupt? And is it a cancer? And if not, if they're not getting it, then, we'll find out in 90 days. And then, we'll decide to part ways at that point.
Yeah, it has been very, very difficult to hire people the last, I'll call it a year. The most challenging period I've ever seen. There's so much competition. It is getting better because the economy is slowing down.
Right.
I think it's going to get a lot better. It's time to upgrade or add. What we found is that we're really incentivizing people by giving them a participating share in the upside of the deal. A lot of people that have been in self-storage and worked for bigger companies, and they get a bonus when they build something, that's great, but they see how much money gets made on self-storage. We're talking $5 or $10 million, and they got a $25,000 bonus. It's disenfranchising. And
it is.
As somebody that, I was in their shoes, I started with really nothing. I know what it feels like, and I know what it means to work for your own money and your own participation. And that's really the kind of people we want. So we've got a pretty unique structure that I think attracts the right people. We make mistakes on who we hire. I think it's key to, and they just might not be a good fit. It doesn't mean they're bad people. It's just not a great fit. It's to recognize that it's a very small industry. Everybody knows everybody. So we never really we don't want to burn bridges. We'll see them at SSA or ISS or see them on a deal. And, for the most part, the industry is collegial and accepting. I think there was this mentality in storage of don't get into it because we want it for ourselves. We've had people tell us don't start a development company. It's too tough. Well, we've kind of been there. I know how tough it is. It is tough, but you can solve for that. So, I love the space. I love the business. I think the opportunities are frankly really broad and really wide, and they might not look like the same opportunities. We're ground up climate control, class A, multi-story. In 5 years, is it going to be that same thing? I don't know, but I know we can pivot to take advantage of it.
Yep. That's good. Well, and that's, once again, that's the exciting thing about this is that I get the chance, at least on this podcast, to talk with smart folks like yourself that are doing the same things and differently and at scale, and be able to talk to some other folks that are in startup mode where I've forgotten, some of the things that I need to be looking at all the time, even at the level that I'm at. And then when we get together at the ISS shows and SSA shows, what I found, Drew, when I get into this industry after being in multifamily and single family and office and warehouse, I've been in all those as well as an individual investor. And anytime I would go to either a conference or some type of a gathering, everybody held the cards close to the chest. And it was so competitive. And I found in storage that people will share 95% of their hand, and they'll just keep the 5% to themselves. But the rest of it is all fair game. And we're only competing, it's very rare that we compete against each other because, our radius is 5 miles, usually 3. So we can share a whole lot of, industry secrets, if you will, and best business practices with folks very freely without them being competition. It's very rare. And so that was just a very a welcoming, refreshing change from the other industries and asset classes that I was investing in and the people that were in them.
Yeah, I agree. I definitely like the people and appreciate the opportunity everybody has to really do well.
Well, Drew, thanks so much for your time. I appreciate it. Good chatting and catching up. I'm hoping to have you back for round 2 where we can maybe take a little deeper dive into the market as we get a little further down the path here and into this ever-changing market. But if there's any piece of advice that you could give to Storage Nation out there, whether they be new folks or experienced folks, what might that be for them to go out and take and put into practice?
Yeah, I share the same advice with especially the young people that are in our organization is you got to show up. If you're sitting behind a computer, Googling Google Earth, it's not the same. You got to go see the site. You got to kick the dirt. You got to go to SSA. You got to meet people. You got to go to the cocktail party. Like if you don't show up, there's only so much, there's magic that happens when you're face to face.
Yep.
And I think the pandemic, it skewed that a little bit, but we want a relationship, especially with our investors. We want to know what they want. We want to know what our partners want. So you got to show up. And it might not always be comfortable for everybody, but it is probably the quickest way to accelerate your career.
100%. Yep, I would agree. We just got back from an event. We do a lot of events. We hold our own and go to others, and just got back from a family office event in New York. And we were the only self-storage folks that were there. And guess we got all the conversations and discussions, about self-storage from these family offices. It was and they can cut to the chase really quick and get beyond the brochures and everything else and ask us about the things that they want to know. Do we have integrity? What's our track record? And how much experience do we have? And what kind of returns are we looking at? And there is no exchange for being in the same room with folks to be able to further that and deepen that relationship, even in a 2-day setting. There's just no substitute. Well, Drew, once again, thanks so much for your time. I appreciate you coming on the show and look forward to having you back again soon, as well as perhaps seeing you at the ISS show in spring.
Be great. I love what you're doing, Scott. Keep up the good work.
All right. Thanks, Drew. You do the same. Take care. Bye now. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.